What makes a good business? This is an age-old question that every business person tries to find answers to, and particularly PE investors who plow up to billions of dollars into businesses with billions more in leverage. Today, I'm going to be going over the 5 most important things PE investors look for in potential investments. But before we begin, try to think yourself about what they may be and let me know down in the comments if you got any of them, and also stick to the end of the video for a bonus answer. Now, before getting started, if you're watching this video because you're interested in breaking into private equity one day, you may want to check out the Private Equity Investing Certificate program being offered by Wall Street Prep and Wharton, which is where I got my MBA. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America PE at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and if you sign up by the early registration deadline, you'll get $200 off, and be sure to use my code rareliquid to get an additional $300 off. Alright, now starting with number 1, one of the most important things PE investors look for are large and ideally growing target addressable markets, also known as TAMs. Oftentimes, even if you find a great business, if its TAM is rapidly shrinking, then it's going to be a bad investment. For example, if back in 2012, a PE firm identified a promising cable provider, no matter how great that business was, it would likely be doomed to fail because streaming and companies like Netflix would rapidly eat market share. On the flip side, if the TAM is growing, then a great company is likely to grow exponentially, such as a well-positioned electric battery company, which would be able to serve more and more customers as the electric vehicle market expands. Beyond just the TAM, PE investors also need to think about how well the company can serve this market, because if the market is enormous and growing, but the company's product, distribution abilities, or go-to-market strategy suck, then it's not going to grow. Taking all of this into account, PE investors will need to find answers to questions like, what is the size and growth of the market? What percentage of the market does the company currently capture? And how much of the TAM can realistically be achieved over time? Who is the target customer and what are their demographics, preferences, and buying behaviors? What is the company's go-to-market strategy and what are its strengths and weaknesses? How will the industry be affected by the economy, technological changes, and other market disruptions? Next on the list is a strong competitive moat, which is a non-negotiable feature of any business a private equity firm invests in. A competitive moat is a company's set of unique advantages such as brand strength, proprietary technology, or cost efficiency that protect it from competitors and ensures long-term profitability. Without a strong moat, a business risks being overtaken by competitors. For example, if a PE firm in 2009 was looking to acquire BlackBerry, which had a very impressive 20% market share of the smartphone market, that would have ended in disaster because even though the smartphone industry would eventually explode, the introduction of the iPhone and Android smartphones would completely dominate, and it became clear that BlackBerry really didn't have a moat that could protect the company from its competitors. In order to analyze a company's moat, PE investors will research the competitive landscape with questions like, who are the primary competitors and how intense is the competition in this sector? Does the company have a cost advantage, proprietary technology, or other differentiators that create a barrier to entry? How strong is the company's brand recognition, and which regions of the markets that it serves does it dominate? Investors will also often use frameworks like Porter's 5 Forces to understand the broader dynamics of the industry, including supplier power, buyer power, and the threat of new entrants. Third on the list, of course, PE investors look for companies with a strong financial profile. Now, this may sound like a given, but PE investors do work within a fairly narrow set of criteria that's different from, say, venture capital investors or hedge fund investors. Because PE firms purchase companies using a lot of leverage, aka debt, they need to look for companies with 3 things. First are stable cash flows. PE firms need to see predictable and consistent inflows of cash over time rather than bumpy, unpredictable profits in order to ensure a business can reliably cover its operating expenses and the increased debt obligations that it's going to face after acquisition. Second is high free cash flow conversion, which is the level of efficiency with which a company is able to turn revenue into cash, and the higher, the better. Third is low capital intensity. A business model that requires minimal investment in capital expenditures to generate revenue leads to higher profitability and scalability. In order to identify these three characteristics, a PE firm will dive extremely deep into a company's financials, looking at volume growth, pricing trends, and margins for every product, and categorizing revenue into geographical regions or tiers in order to ultimately build operating models and LBOs, which you can learn about more in this video. These traits ensure the company is able to service debt, pay dividends, create opportunities for growth through reinvestment or M&A, which ultimately all lead to risk mitigation and higher returns over the investment horizon. Before moving on, I really quickly wanted to let you know that I'm working on a free series of 10 emails that will consist of my best tips for breaking into investment banking, which is often needed before breaking into private equity. I'll be including everything I gained from being the JP Morgan UC Berkeley recruiting captain for 2 years and coaching hundreds of students who have gone into all of the top banks. So if you're interested, check the video's description to sign up. Going back to our list, the fourth thing PE investors look for are strong unit economics in order to determine the company's ability to scale efficiently. Unit economics refer to the direct revenue and costs associated with a single unit of a product or service, and is a way PE investors can evaluate profitability and scalability of a business model. For example, Shopify and other similar software subscription companies have excellent unit economics because the company can earn an increasingly larger amount of revenue per merchant as the merchant grows through issuing more fees and additional services, while at the same time, adding one additional merchant on the Shopify platform hardly changes any costs. And also, once a merchant is set up, the retention rate is strong since it's such a pain to switch to different platforms. On the other hand, WeWork is an example of a company with terrible unit economics. This is because the amount of revenue at each building is fairly fixed due to rent prices not really changing that much and also being very competitive. And you also can't scale unless you buy more buildings. In addition, costs are extremely high to purchase or lease buildings and then renovate them. And lastly, there's little stickiness to the service and people can easily stop renting the workspaces out. In order to determine the strength of a company's unit economics, PE investors will evaluate questions such as what is the company's unique value proposition, what is the product, and what makes it stand out in the market? How sticky is the product and what are churn rates like? Is there an opportunity for additional revenue sources to kind of upsell for each individual customer over time? What are the fixed versus variable costs for each unit, and how do margins evolve as the company scales? Last but not least, behind every great business is a great management team, and there's really no exception to this because if a team is not strong, the business will ultimately fail. So this is one of the most important things PE investors look for. In order to evaluate a management team, more than just looking at credentials, PE investors will meet with teams in person in a management meeting after a first round bid is accepted, and then constantly interact with the team throughout the entire diligence process and until a deal closes. During this time, PE investors will ask management teams about the following. 1, about the business, including their view on competitive advantages, opportunities, and threats, the industry and its growth potential and where their business sits in the competitive landscape, the team itself and where their strengths and weaknesses lie, and then 4th, the team's vision when it comes to operations, growth, and strategy. Throughout this whole time, PE investors are looking to answer the question, is the management team credible and backable? If so, then they can stay on, but if not, everyone, including the CEO, may be kicked out once the company is acquired. Alright, so that wraps up the 5 things PE investors look for in businesses. And as I promised in the intro of this video, a bonus factor PE firms look for are viable exit plans. Because no matter how great a business is, if you're not ultimately able to sell it via M&A or IPO, then there will be no returns gained and all that hard work you do as a PE investor will be for nothing. In the next screen, you're going to see a video about the 3 stages of a live PE deal. Highly recommended if you want a lot of insight as to what a live deal is like in private equity. With that said, thank you all so much for watching as always and hope to catch you all in the next video.